Hello everyone, I'm Dr. Kalpana. Today we are going to discuss about corporate finance and security. This topic is important when any company or corporation comes into existence after incorporation, means when a company is registered with Registrar of Company under Companies Act 2013. So, in this context of company law, corporate finance is not just a managerial function but a legal process governed by statutory provisions of Companies Act 2013, Security Contracts Regulation Act 1956, SEBI regulations, and other related laws. So, the objective is to strike a balance between business growth, legal compliance, and above all, investor protection is the key objective of all these regulations. Today, in this lecture, we will explore the fundamental concepts, importance, and various types of financial instruments that drive the corporate world. This presentation aims to provide a comprehensive overview of how companies raise and manage capital and legal framework governing these activities. Corporate finance, what are the meaning of it? Uh, what are the need and how important it is? So, corporate finance refers to the financial activities related to raising capital, managing company fund, and maximizing shareholder value. Why it is important? It is important because for expansion of the company and diversification. And secondly, procurement of raw materials and machinery to run a company, whatever the need a company according to its profile does have. Meeting working capital needs. Working capital needs means whatever expenses are required to run a company. We call it working capital. Payment of wages and salary. It's very obvious when a company is coming into existence, we require a working force, human resource. So sometime it is a labor which is based on wages and employees which are who are salaried. Research and innovation, regulatory compliance is definitely requires some funds. So these are the expenses which a company requires, and capital is required and funds are required. So a company needs funds, capital, and how this capital is procured from the market. For example, a startup requires 10 crore to launch a pan-India food delivery platform, as we see Zomato, Swiggy. So this can be raised via issue of equity shares, venture capital, or debentures. So these are financial instruments. Now coming to securities. What is the meaning of securities in company law and its legal definition? Section 2H of Security Contract Regulation Act defines security broadly. It includes shares, scrips, stocks, bonds, debentures, derivatives, units of mutual funds, government securities, and right or interest in securities. You must have heard all these terms. If anyone of you who is listening to this lecture is having little idea of demat accounts or share market, you would be finding all these mutual fund, bonds, debentures are offered by the companies which are listed with SEBI. So key elements, securities are transferable financial instruments, represent financial value, and can be listed or unlisted. Types of security. Equity share. You must have heard this term very often. Equity market, we would be investing in equity where the shares are going up, sometime going down, according to how money is being invested into a particular share. Ownership interest, equity shares represent an ownership stake in the company. Voting rights, shareholders typically have voting rights on company matters. If any one of you is dealing with share market, dealing in equity share, must have received certain emails regarding annual journal meetings, which I would be dealing with that topic in a separate lecture. What is a meeting and what kinds of meeting, what is the relevance, etc. Dividend distribution are paid based on company profit if declared. There are certain companies who pay dividend. Dividend is basically a profit earned by the company, and according to the share proportion, that dividend as a matter of profit is distributed among shareholders. For example, a company issues 1 lakh equity share as 10 rupees per share, granting purchasers a proportional ownership and voting power. That is a very simple metrics to understand how equity shares work with the shareholders. Types of securities, preference shares. What is preferential right or share? So preference shares offer preferential right over equity share in terms of dividend and capital repayment. If someone is holding preferential shares, then preference would be given over equity shareholders in terms of dividend and capital repayment. Non-voting, generally holders of preference share do not have voting rights. So that is very important to know. Preference shareholders are not having voting right like equity shareholders. Types, common types include cumulative, non-cumulative, redeemable, and participating preference share. These are the types of preference shares. Now coming to debenture. Debenture is also another type of a security. So debenture is basically a debt instrument, loan instrument, you can call it interchangeably. Debentures are essentially loan instrument issued by companies on which fixed rate of interest is given to the investor in the form of interest repayment as we give to bank whenever we are a debtor. There are two types of debenture instrument, secured and unsecured. Debenture can be either secured. Secured means when it is backed by assets, there is some collateral um, parallel to that debenture is there. Unsecured where there is no asset collateral. Section 71 of Companies Act 2013 especially deals with regulation surrounding debentures. Bonds. This is another type of security. Issuers bonds are primarily issued by governments or large corporations. So you must have heard investing in bonds is very secure, safe, and there might be little gain, but it is safe investment. So risk profile, they are generally considered lower risk compared to other securities like equity share, debentures, etc. Bonds offer a fixed interest rate, interest payment to investors over a specified period. So that is the stimulus as gain. Derivatives and mutual fund. I believe many of you must be knowing about SIP of mutual funds through advertisements. So derivatives are financial contracts whose value is derived from underlying assets such as futures and options. That is also available on the interface of uh, share market. When you open the interface of any demat account, you can find futures, options, derivatives, bonds, etc., and mutual funds also. So investment vehicle that pool money from multiple investors to invest in diversified portfolio of security. I believe many of you must be knowing about mutual funds. Regulation, both derivatives and mutual funds are regulated by SEBI, Security and Exchange Board of India. Many derivatives are actively traded on stock exchanges like BSE and NSE. Creation of shares, how shares are created. Section 61 to 64 of Companies Act 2013 governs the creation of shares. A notable case, Banquet Chalapathy versus Highland Coffee Works established that a company cannot issue shares beyond its authorized capital. So allotment and register, shares are allotted and recorded in register of members. Filing with ROC, Registrar of Company. Necessary documents are filed with Registrar of Companies. Board of Resolution, Companies Board passes a resolution to issue share, without which it does not have any legal backup. Authorized capital, maximum capital a company can issue stated in Memorandum of Association. The meaning of authorized capital means whatever the maximum capital a company can issue, which has been stated in Memorandum of Association. Issue of shares. So public issue, share offered to public through IPO, that is initial public offer. You must have heard about it. Company launches IPO in order to raise funds, requiring a prospectus under Section 26. Rights issue offered proportionally to existing shareholders under Section 62. Bonus share issued free from company reserves to existing shareholders. Private placement offers to select a group of 200 investors per financial years, requiring a PACE 4 form, no public advertisement. That is called private placement. For example, a startup raises 50 crore from angel investors via private placement, demonstrating a common method of capital acquisition. So that is all about corporate finance and securities. So whenever a company comes into existence, first of all, it requires money, capital, resources, human resource in order to afford all the structure and functioning of the company. These are the instruments by which a company raises fund like debenture, issue of share, preferential share, equity share, bonds, etc. With this, I would end here. Happy learning. Have a good day. Take care.